What's up everyone and welcome back to the channel. If you're just joining us, you've picked the perfect day to tune in because we're about to dive deep into some of the most significant market moving stories that are happening right now. And I'm talking about the kind of analysts. What's up everyone and welcome back to the channel. And analysis that separates successful long-term investors from people who just chase headlines and hot tips. I'm your host, and today we're going to cover three absolutely massive stories that are shaping the investment landscape as we speak. We've got Tesla making headlines with some fascinating SEC filings that reveal exactly what Elon Musk has been doing with his own money. We're going to break down the Federal Reserve's latest signals about interest rate cuts and what that actually means for your portfolio. And we will analyze the explosive situation between Nvidia and Chinese regulators that's sending shockwaves through the entire technology sector. But here's what makes this stream different from all the noise you will hear elsewhere. We're not just going to tell you what happened, we are going to show you how to read the actual documents, understand the real implications, and most importantly, figure out what all of this means for building wealth in the stock market. So if you're new to investing, or if you've been trading for years but you're tired of getting your market analysis from random tweets or clickbait thumbnails, you're in exactly the right place. We're going to teach you how to analyze SEC filings like a professional investor, how to understand Federal Reserve policy beyond the surface level headlines, and how to navigate the complex world of geopolitical risk in technology stocks. Now, before we get started, make sure you hit the subscribe button and ring the notification bell, because this is a kind of educational content that can literally change how you approach investing. We are building a community of serious investors who want to understand not just what to buy, but why to buy it and when to sell it. Throughout today's stream, I'm going to be asking for your input in the comments. This isn't just me talking to you. This is a conversation. I want to hear your thoughts, your questions, and your investment strategies. Some of the best insights come from our community members who are dealing with the same market challenges you are. And if you find value in what we're covering today, please hit that like button. It really does help the channel reach more people who are serious about learning how to invest rather than just gambling on stock tips they heard somewhere. Alright, let's jump right into our first story, and trust me, by the end of this stream, you're going to have a completely different perspective on how to analyze market news and make smarter investment decisions. Alright folks, let's talk about the big elephant in the room here, or should I say, the big Tesla in the room. So, Elon just dropped about $1 billion of his own money into Tesla stock. Yeah, you heard me right, a billion with a B. And now the stock just went absolutely crazy on Thursday and Friday. Now here's what's interesting. Tesla didn't announce some brand new car or some crazy AI breakthrough. No. What we're seeing here is just a good old technical analysis playing out. Hold on, if you're new to stocks and you're like, what's that? What's technical analysis? Don't worry, it's way simple than it sounds. Basically, you look at stock charts and find patterns. Let me show you. So we are on the 1 hour Tesla chart. you think of it like a basketball bouncing back and forth between two walls. Tesla has been bouncing between about as you can see, Tesla has been bouncing between about $318 and $318 and $347 for months now. For month, you can, as you can see, just a back and forth. Then what happened? Then last week, boom! Tesla finally broke through that top wall, that 347, that level, $347 level, like a basketball smashing right through the ceiling. But why now, right? What was the spark? Well, here's where it gets really interesting. Around the same time, Tesla board member Robin DeHome came out publicly praising Elon. Now, as you can see the headlines, and then Elon himself was quietly buying up his own company stock. Let's hear it together.
Time at Tesla and also in the world. I mean, AI and autonomous and the application of AI is transformative technologies. And we believe at Tesla in big, ambitious goals. And so Elon put out the Master Plan 4 on the 1st of September, very auspicious day, I think, in terms of putting out the vision for the company for the next decade or more. And AI and autonomous is at the front and centre of that, both in the vehicles, but also in our Optimus lineup and what we're doing from a robotics perspective as well. And so having the board's responsibility.
So we all heard that, and then Elon just bought his own company stock. It's like Elon is saying, you know what? I'm so confident in myself. I'm putting $1 billion where my mouth is. That psychology is huge on Wall Street. Traders see that and they're like, wow, Elon's betting on himself. Maybe I should too, right? Maybe I should do the same. And then the whole thing just feeds on itself. Honestly, props to Elon. Thanks, Elon. Congratulations to Elon. If this was chess, he just put off a checkmate on the short sellers. Speaking of shorts, oh man, they're getting crushed right now. If you don't know what short sellers are, they're basically people betting that a stock will go down, but when the stock shoots up instead, they have to buy shares to cover their bets, which makes the stock go up even more. It's like throwing gas on the fire. Right now, let's go back to Tesla's chart. Right now, before the market, Tesla is trading around 416.47 USD, which is way past even that 414 target that a lot of traders were watching. Big move, big energy for sure. Now, I want to hear from you guys in the chat. Do you think this breakout is going to keep going, or are we just watching a short squeeze that's gonna fizzle out? Drop your thoughts. I really want to see what everyone's thinking. And hey, if you're enjoying this so far, do me a favor and smash that like button. Hit subscribe and share this with someone who is also trying to figure out Tesla. Let's grow this community together. So here is where things get even more interesting. a lot of people are saying, and by saying I mean shouting on Twitter, on X, that Elon's billion-dollar buy isn't just about the stock price. It might be about power. Here's the deal. Elon's been wanting to get about 25% of the voting power at Tesla. That's a magic number where he has enough influence to control the company's direction without being able to just run over everyone else. It's like having just enough chips at the poker table to call the shots. So even Elon Musk wants more power. Now, even with his massive pay package, and we're talking seriously massive, he's still a bit short of that 25%. So investors are wondering, is this billion-dollar buy just the first move? Could Elon be quietly stacking up more shares until he hits that sweet spot? And here's what's really wild. Let me show you, just 1 second, alright? Elon posted his cryptic message on 11:14 p.m. September 7th, 2025. All he said was, "You will thank me later." This was when Tesla was sitting right around it's around September 17th. So that's around 347 level. At that time, nobody knew what he meant, but looking back now, it's like he was winking at us, saying, "Buckle up. Something is coming. Something big is coming." Now look back at the timeline. September 8th, he makes that mysterious post. "You will thank me later." Next few days, stock dips a bit, loses at $347 line, then boom by 11th and 12th. September 11th and September 12th, Tesla stock shoots up right as news comes out about his big purchases, and the board member praising him. That's not luck, folks. That's strategy. Elon wasn't just buying stock; he was soaking up all the selling pressure and pushing the price up. And if you're on team Tesla, that's pretty exciting to watch. But here's what I think is really going on. This isn't just about stock price or short-term games. No, not at all. I think Elon is sending a clear message. He is back. Back in the CEO seat, back focusing on Tesla, back putting his full weight behind the company. Let's be real, nobody will ever care about your business as much as you do, right? That's the difference between some hired manager and Elon Musk. Elon treats Tesla like his baby. When he's fully logged in, you can feel it and it's everything the company does. Sure, people joke about him getting distracted by politics or the Dogecoin memes, but when Elon is really running the show, Tesla doesn't feel like some boring car company. It feels like what it really is, a $1.3 trillion startup. And that's why this moment matters. It's not just about buying stock. It's Elon planting a flag and saying, I'm here, I'm logged in, let's build something. So let me ask you guys, do you think Elon is back in full CEO mode for good? Do you think so? Or is this just temporarily before he gets distracted again? I want to hear from both the bulls and the skeptics. And if you just joined us, make sure to hit that like button and subscribe. Thank you so much, guys. We've got way more to cover about Tesla and the markets today. So, alright, let's zoom out and talk about what this all means for Tesla going forward. Because from here, the story splits into two paths: the short-term hype train and the long-term fundamentals. First, short-term. Tesla's got some serious wind at its back right now. Three big things. The interest rates are coming down. When rates drop, growth stocks like Tesla usually do really well. Why? Because it's cheaper for people to borrow money for big purchases like cars, and cheaper for companies to borrow money to expand. Think of it like lowering your credit card rate. Suddenly, buying that expensive thing doesn't hurt as much. Tesla has always been super sensitive to interest rates. And also the end of quarter push. This is huge. Tesla is throwing every incentive they have at people right now. The 0% financing on Cybertrucks. Discounts if you buy a second Tesla. And don't forget that $7,500 federal EV tax credit expires for many models at the end of September this year, 2025. It's like a giant coupon with an expiration date. If you want the deal, you gotta act it before September 30th. And we know from history, when there's a deadline like this, car sales can go crazy. And of course, Elon is back. When the CEO is visibly engaged, buying shares and hyping the company, that brings confidence to investors and employees. Like I said before, nobody cares about Tesla more than Elon. And when he's locked in, you feel it. You actually can feel it. Put those three things together: lower rates, quarter-end deals, Elon fully engaged, and you've got some explosive short-term momentum. This could honestly lead to one of Tesla's biggest quarterly deliveries numbers ever. Now let's do the reality check. Here's the reality check. Momentum isn't the same as fundamentals. Right now, Tesla's valuation is pretty stretched. The price to earnings ratios are sky high. Eventually, the hype has to hand things over to real earnings growth, right? That's where the long-term story comes in. We're talking about the robo-taxi. This is Tesla's moonshot. Robotaxi is Tesla's moonshot. The idea is simple. Turn your car into an Uber that drives itself while you sleep. No driver, no labor costs, pure revenue. But for that to work, Tesla has to get rid of the safety driver and prove the tech is ready. Investors want to see real robotaxi money showing up in earnings within the next 2 to 3 years. Until then, it's still a trust me story. And let's not forget about the other projects like Optimus, Tesla's humanoid robot. You've probably seen the jokes. Someone said when it cleans your house, it will be called Optimus Grim. That's a kind of dad joke we live for in this community. But seriously, behind the humor, the potential is massive. If Optimus ever scales up, we're not just talking cars anymore. We're talking about a whole new labor market. So here's how I see it. Short term equals hype. Momentum, short squeeze fuel. Long term equals fundamentals, and those fundamentals depend on whether Tesla can actually deliver on robotaxi and everything else. How do you guys think? Let me know in the chat. Are you here for the short-term trade, riding this breakout, or are you holding for the big vision, the robotaxi, Optimus, and the whole Tesla futuristic thing? Let me know in the chat. And if you're just joining us, hit that like button and subscribe so you don't miss the rest of this Tesla breakdown. We've got more coming. Alright guys, let's tie this all together. Short term, we've got our three catalysts. Lower interest rates, the quarter end push with that 7,500 tax credit, and Elon adding fuel to the fire with his $1 billion buy. That's like pouring gas on an already hot grill. Lots of sizzle and excitement. But then comes a medium term. And this is where Tesla really needs a real catalyst and not just a hype. The obvious one, robotaxi. The moment Tesla gets rid of the safety driver and prove the car can drive paying passengers alone, that's when margins explode. Because right now Tesla's basically paying someone to sit in the car like an Uber driver while the customer gets a cheap ride. The second the driver's gone, boom, those labor costs disappear and Tesla keeps all the revenue. That's a game changer. Optimus is fun to think about, and I love those Optimus grim jokes as much as anyone else, but that's way down the road. Robotaxi is a nearer term short at real, scalable profits. Now let's talk price action for a minute. So to me, the key level for me, it is 414. For me, the $414 is the key level. Tesla needs to hold above that line, and honestly, it makes sense that the stock pulling off a bit toward that number. In a big picture, I don't see major red flags until maybe early October. Could we see weakness later this year? Sure, Q4 always brings recession talk, but right now things look stable enough that Tesla's momentum can keep running. And here's my take on Elon's buying. I don't think he's starting some big shopping spree. My gut says this was more of a one and done signal. Maybe he will do one more round of buying, but I doubt this becomes a regular thing. This was about sending a message, and honestly, it worked perfectly. It reminded me of Alex Carp over that Palantir. That guy is basically a salesman for his own stock. Elon just put the original version of that move. So props to the Tesla community. It's a wild time, and if you are holding Tesla, this is one of those weeks where you just sit back and say, yep, this is why I signed up for this ride. Let me ask you before we move on, guys. So here's a question for you guys. Do you think Elon's buying spree continues, or was this just a one-time move to pump confidence? I'm curious, what do you think? And as always, smash that like button, subscribe if you haven't yet, and share this with someone who's also trying to figure out the Tesla roller coaster. We've got pretty more coming up, but that's a Tesla breakdown for now. So if you're new here, make sure to hit that subscribe button, because we're about to break down some serious market intelligence that most people completely miss. Now we're diving into something that separates the real investors from the noise traders. Let me show you. And that's understanding how to read the official paperwork that companies file with the government. Alright guys, let's take a look at Tesla's investor relations page. As you can see, did you see that? Let me know. I hope it shows up properly. So, because this is where the official paperwork lives, straight from the SEC, no rumors, no leaks, and look at this. On September 15th, 2025, September 15th, 2025, September 15th, 2025, yeah, those are 3 documents. So Tesla dropped 3 new filings. Let's walk through them because they give us a lot of context for what's going on. By the way, before that, let me tell you something. While everyone else is getting their investment advice from random tweets and YouTube thumbnails with shocked faces, smart money is looking at the actual documents. The Securities and Exchange Commission, that's the SEC, requires every public company to file specific forms whenever important stuff happens. And I'm talking about the real deal here, not speculation or sources close to the matter. When a company CEO buys or sells stock, when they're planning major votes, when insiders are making moves, all of this gets documented in legal filings that anyone can read. It's like having a backstage pass to see what's really going on inside these companies. So today we're going to look at Tesla. And before you roll your eyes thinking, oh great, another Tesla stuff, stick with me please, because the recent filings tells a fascinating story that goes way beyond just the stock price. And now I'm gonna break down Tesla's recent SEC activity. On September 15th, 2025, Tesla submitted not 1, not 2, but 3 different forms to the SEC. Now, most people saw this and probably thought boring paperwork and scrolled past. But here's the thing, when a company files multiple forms on the same day, that usually means something significant is brewing. Let's walk through each one of these filings and I explain what they mean. So here we go, the form DEFA14A, the shareholder communication game. The first filing is something called DEFA14A. Now I know that sounds like random letters and numbers, but here's what it actually means. It's additional information that Tesla is sending to their shareholders before they vote on important company matters. Think about it like this. When you vote in an election, you might get a voter guide in the mail that explains what each ballot measures means, right? Well, the DEFA14A is basically Tesla's way of giving shareholders extra context before they make important decisions about the company. What kind of decisions are we talking about? Well, things like who gets elected to the board of directors, how much the CEO should be paid, and here's where it gets really interesting. Rules that could change how voting power is distributed among shareholders. Now, why should you care about this as an investor or potential investor? Because shareholder voting determines the direction of the company. So if you own Tesla stock, you literally get a say in how the company is run. And if you're thinking about buying Tesla stock, understanding the power dynamics between management and shareholders can give you insight into where the company is headed. There's been ongoing discussion about Elon Musk wanting to increase his voting control to around 25% of the company. When you see a DEFA14A filing, it often signals that management is preparing for important shareholder votes, and in Tesla's case, This could be directly related to restructuring voting power. Next, Form 4. Following the Monday trail, now here's where things get really interesting. The second filing is the Form 4, and this one is absolutely crucial for understanding what's happening inside the company. A Form 4 is what's called an insider trading disclosure. Don't worry, when I say insider trading, I'm not talking about anything illegal, alright? Don't worry. I'm talking about the completely legal and transparent process where company officers, directors, and major shareholders have to report whenever they buy or sell stock in their own company. By law, these people have to file a Form 4 within 2 business days of making any transaction. So when you see a Form 4, you're getting real-time intelligence about what the people who know the company best are doing with their money. And here's what Tesla's Form 4 revealed. Elon Musk personally bought Tesla shares on September 12th. As you can see, name and address of the reporting person, Elon Musk, and date of earliest transaction, September 12th, 2025. We're talking about the CEO of the company putting his own money where his mouth is. The average price he paid was between, I'm talking about the average price, it's about $396.12 and $396.54 per share. Now let me explain why this is such a big deal. So when a CEO buys stock in their own company, it sends a powerful signal to the market. Think about it. Who knows more about Tesla's future prospects than Elon Musk? He has access to internal financial data, upcoming product launches, manufacturing numbers, and the strategic plans that the general public won't know about for months. So when he's willing to spend his own money to buy more Tesla stock at nearly $400 per share, that suggests he believes the stock is undervalued at the price. It's like getting a peek at the CEO's personal confidence level in the company's future. Oh, I just saw someone text in the chat. I bought some Tesla TSLA at 400 yesterday. Should I sell it when the market opens? No, I don't think so. As we just mentioned before, pay attention to the $414 level, all right? And as we just mentioned, Elon bought the Tesla stock at nearly $400 per share, approximately. So I don't think you need to worry about your position. Now let's move on to the next file, the 144, the Form 144, the other side of the coin. The third filing, it's a Form 144. And this one adds an interesting wrinkle to the story. A Form 144 is essentially a notification that someone with insider access to the company is planning to sell shares in the future. Now, before you panic and think, oh no, insiders are selling, let me explain how this actually works. Don't panic. So a Form 144 doesn't mean shares being sold immediately, all right? It's more like filing paperwork that gives someone the legal ability to sell shares under specific conditions and time frames. There are lots of legitimate reasons why insiders might file a Form 144. Maybe they need to diversify their portfolio. Maybe they have personal financial obligations. Maybe they are following a predetermined selling plan and that was set up months ago to avoid any appearance of impropriety. The key point is that while Elon Musk is buying shares, someone else with insider access is positioning themselves to potentially sell shares in the future. This creates an interesting dynamic where you have both bullish and cautious signals coming from people who have inside knowledge of the company. So, what does this all mean for us regular investors, like retail investors? So when you step back and look at all three filings together, you get a pretty complex picture. On the one hand, you have the CEO demonstrating confidence by buying shares with his own money. And on the other hand, you have preparation for important shareholder votes and potential insider selling on the horizon. This is exactly the kind of nuanced analysis that separates successful long-term investors from people who just chase headlines and hot tips. The market isn't just good or bad, it is constantly balancing different signals and trying to figure out what they mean for future performance. For Tesla specifically, these filings suggest we're in a period where short-term momentum, medium-term strategic decisions, and long-term fundamentals are all playing out simultaneously. The CEO's personal stock purchases suggest a confidence in the near-term outlook. The shareholder voting materials suggest important governance changes could be coming, and the potential for insider selling suggests that not everyone's uniformly bullish about the immediate future. Now, I want to hear what you think about this, guys. Let me know, when you look at these three filings together, do you think them as primarily bullish because the CEO is putting his own money into the stock? What do you think? Or does the potential for insider selling make you more cautious about Tesla's near-term prospects? Drop your thoughts in the comments below, and if you found this deep dive into SEC filings helpful, make sure to hit that like button and subscribe, because we're going to make this kind of behind-the-scenes analysis a regular part of what we do here. Most people are content to trade based on headlines and rumors, but you're going to have access to the real data that moves markets. And trust me, once you start reading these filings regularly, you will never go back to relying on second-hand market gossip. Now let's shift gears and talk about something that's affecting every single stock in the market right now, and that's the Federal Reserve and interest rates.
We pretty much agree with that call, and that of course would be a pivot from the June positioning, which was very much emphasizing we'll do whatever we have to do to fight inflation. So, but the motivation.
So what we're gonna talk about is huge. This is huge, my friends. So make sure you are subscribed, because we're about to break down one of the most important economic stories of the year. Here's a $1 million question that's keeping Wall Street up at night. Is the Federal Reserve finally going to start cutting interest rates? And more importantly for us as investors, what does that actually mean for our portfolios? Let me paint you a picture of what's happening right now at the Federal Reserve. Just imagine you're trying to drive a car where the gas pedal controls inflation and the brake pedal controls employment. Your job is to keep the car moving at exactly the right speed, not too fast that you lose control, and not too low not too slow that you stall out. That's essentially what Fed Chairman Jerome Powell and his team are dealing with right now. Except instead of a car, they are steering the US economy, the American economy. The market is convinced that rate cuts are coming. Traders and investors are basically betting that the Fed is going to respond to some concerning employment data by implementing what economists call sequential rate cuts, meaning one rate reduction followed by another, and possibly another after that. Here's what makes this situation so fascinating from a historical perspective. Just back in June, the Federal Reserve was taking what you might call a tough guy stance on inflation. The message from Fed officials was crystal clear. We will do whatever it takes to bring inflation back down to our 2% target, even if it means some economic pain. But here we are, just a few months later, and that tune is starting to change. Why? Because the labor market is showing signs of cooling off, and the Fed has what's called a dual mandate. They're not just responsible for controlling inflation, they're also supposed to support maximum employment. So, this creates a really interesting debate among economists and market watchers. On one side, you have people saying, look, the economy is slowing down, job creation is weakening, why not be proactive? But raised by a significant amount, maybe 50 basis points, and get ahead of this economic slowdown before it becomes something worse. On the other side, you have people arguing, hold up, inflation is still running hotter than the Fed wants it to be. We are seeing prices rise due to various factors, including trade policies and supply chain issues. If you cut rates too aggressively right now, you might accidentally fuel another round of inflation. So let me give you the actual numbers so you can understand why this is such a delicate balancing act. Right now, unemployment is sitting at around 4.3%. The Fed's economists believe that the long-term sustainable unemployment rate, what they call the natural rate, is around 4.2%. So we're talking about being just 1/10 of a percentage point above that, above what they consider ideal. That means, yes, the job market has slowed down from where it was, but we're not exactly in crisis territory either. No, we're not there. Meanwhile, inflation is proving to be what economists call sticky, meaning it's not coming down as quickly as the Fed hoped it would. Various factors are keeping prices elevated, including trade policy impacts and the labor market dynamics. Here's where it gets really interesting for us as investors trying to understand where the economy is headed. We're not looking at an economy that's falling off a cliff. That's not what the data shows. Yes, certain sectors are definitely feeling the impact of higher interest rates. The housing market is struggling because higher interest rates make mortgages more expensive, which reduces demand for homes. And so, as you can see, let's talk about the construction. Construction companies are seeing projects get delayed or canceled because financing is more expensive. These are real impacts that real people are feeling, but other parts of the economy are telling a different story. Consumer spending is still relatively robust. People are still shopping, still going out to eat, still buying things they need and want. Industrial production hasn't collapsed. Business confidence surveys are not showing panic. So the Federal Reserve is essentially looking at a split-screen economy. On one screen, they see housing and employment showing clear signs of stress. And on the other screen, they see consumer spending and business activity that's still relatively healthy. This is why Fed policy is so challenging and why their decisions matter so much for investors. Cut rates too much too fast and you risk reigniting inflation just when you thought you had it under control. Don't cut rates enough or fast enough, and you risk letting the weak spots in the economy spread and create a broader slowdown. So here's my take on what the Fed is likely to do. Expect them to lean toward gradual, measured rate cuts rather than dramatic moves, unless the economic data gets significantly uglier than it is right now. Don't expect to see aggressive 50 basis point cuts. But here's the key question for us as investors. What does the Fed rate cut environment actually mean for the stock market? Because that's what we really care about, right? So let me break this down into different sectors and explain how rate cuts typically flow through the stock prices. Growth stocks and technology. First up, growth stocks and technology companies typically love lower interest rates. Here's why. When the Fed cuts rates, it becomes cheaper for companies to borrow money to fund expansion, research and development, and new projects. This is especially important for technology companies and other growth-oriented businesses that often rely on debt financing to fuel their growth. When money is cheaper to borrow, investors are also more willing to pay higher prices for stocks of companies that promise big profits in the future, even if those profits are years away. Think about companies in sectors like electric vehicles, artificial intelligence, biotechnology, and clean energy. These are businesses where the big payoffs might be several years down the road, but when interest rates are low, investors are more patient about waiting for those returns. And real estate and housing related investments, lower rates can provide a boost to real estate and housing related investments. Although this impact isn't always immediate, when the Fed cuts rates, mortgage rates often, but not always, come down as well, which can make buying a home more affordable for consumers. This potentially helps companies involved in home building, construction materials, home improvement, and the real estate services. It can also benefit real estate investment trusts, REITs, which are companies that own and operate income-producing real estate. However, keep in mind that the housing market is also affected by factors beyond just the interest rates, including home prices, inventory levels, and consumer confidence about their financial future. The finance sector is responsible to rate cuts is more complicated. On the one hand, banks typically make money by borrowing at lower rates and lending at higher rates. So when rates fall across the board, their profit margins can get squeezed. On the other hand, lower rates can stimulate economic activity, which means more people and businesses taking out loans, which is good for banks' business volume. Lower rates can also reduce the number of loan defaults if people find it easier to make their payments. So whether financial stock benefit from rate cuts often depends on the specific reasons for the cuts and what happens to the broader economy as a result. When the Fed cuts rates, consumers often see benefits in the form of lower interest rates on credit cards, auto loans, and other forms of borrowing. This puts more money in people's pockets, which they can then spend on goods and services. This potentially benefits retail companies, restaurants, entertainment businesses, travel companies, and other consumer-focused business. However, consumers also need to feel confident about their jobs and financial security before they increase their spending significantly. Here's something really important that a lot of people miss when they are thinking about Fed rate cuts. The reason behind the cuts matters just as much as the cuts themselves. If Fed cuts rates because they want to be proactive and support continued economic growth, that's generally viewed as positive by the stock market. But if the Fed cuts rates because the economy is actually in worse shape, then people realized that can actually be negative for stocks even though rates are coming down. Remember, rate cuts don't magically fix the underlying economic problems. If companies start reporting lower earnings, if unemployment rises significantly, if consumer spending drops off, all of these things can still hurt stock prices even in a lower interest rate environment. Let me give you a historic example that illustrates this point perfectly. Back in 2020, when the pandemic hit, the Fed cut rates all the way to 0%. Technology and growth stocks went absolutely parabolic. They skyrocketed in value because investors piled into companies that promised big growth in the future. But then in 2022, when inflation became a serious problem and the Fed started raising rates aggressively, those same technology and growth stocks get absolutely crushed. The exact same companies that benefited the most from low rates suffered the most when rates just went back. So here's my framework for thinking about potential rate cuts and other impact on different parts of the stock market. Short-term winners expect technology and growth stocks to get the biggest immediate boost from rate cuts, especially if the cuts are seen as supporting continued economic expansion rather than responding to crises. Medium-term opportunities. Keep an eye on housing-related companies and consumer-focused businesses for signs of improvement as low interest potentially stimulate activity in those sectors. Proceed with caution. If rate cuts are happening because the economy is weaker than expected, defensive sectors like utilities, healthcare, and consumer staples might actually be safer investment than high-growth stocks. I want you to think about this question. If the Fed does implement a rate cut this year, which sectors do you think will benefit the most? Are you leaning toward technology and growth stocks that typically respond well to low rates? Are you thinking about housing and real estate plays, or are you more interested in consumer companies that might benefit from people having more spending money? Drop your thoughts in the comments below. Drop your thoughts in the chat and let's get discussion going about how different types of rate cuts might affect various investment strategies. And hey, if this kind of detailed analysis of Fed policy and its market implications is helpful to you, make sure you hit the like button and subscribe to the channel. We're going to keep covering not just what the Federal Reserve does, but how the decisions actually flow through to affect your investment portfolio. Because at the end of the day, that's what matters most for building wealth in the stock market, right? So next, alright everyone, we need to talk about something major. Some major news that just broke in the technology sector. 1 second, let me show you. Alright guys, everyone, we need to talk about this one. We're talking about a story that involves artificial intelligence. Well, wait a second. Okay, we're talking about Nvidia. That is a story that involves artificial intelligence, international trade wars, and billions of dollars in market value that could swing based on regulatory decisions. So what happened? Chinese regulator just dropped a bombshell accusation against Nvidia, claiming the company violated China's antimonopoly laws. Here we go. China's anti-monopoly laws. Now before your eyes glaze over thinking, oh great, more regulatory stuff. Stick with me, please stick with me, because this story is absolutely fascinating and is going to affect way more than just Nvidia's stock price. Let me give you the backstory here. A few years ago, back in 2020, Nvidia made a major acquisition. So let me show you. They bought a company called Mellanox Technologies for approximately $6.9 billion. Now, Mellanox wasn't a household name like Nvidia, but they were absolutely critical in the data networking and transmission pace. Basically, they made the technology that helps data centers and high-performance computers communicate with each other effectively, efficiently. This was a strategic acquisition for Nvidia because as artificial intelligence and machine learning became more important, companies needed not just the powerful processors but also the networking infrastructure to connect those processors together effectively. So Mellanox gave Nvidia a key piece of that puzzle. Here's where it gets interesting. China actually approved this acquisition back when it happened. It wasn't like they blocked the deal or said absolutely not. No, they didn't do that. And this is a big but. They approved it with specific conditions attached. Think of it like getting permission to do something, but with rules you have to follow. According to Chinese regulators, Nvidia didn't fully comply with those conditions. They're essentially saying, we gave you permission to buy this company, but you didn't do what you promised you to do afterward. Let me take a step back and explain what antitrust or anti-monopoly laws are all about, because this is crucial for understanding not just this Nvidia situation, but how governments around the world are approaching big technology companies. Antitrust laws exist to prevent any signal company from gaining so much market power that they can unfairly crush competition or manipulate prices. Imagine if there was only one grocery store in your entire city. They could charge whatever they wanted for food because you'd have no choice but to pay it, right? Antitrust laws are designed to prevent that kind of situation. In the technology sector, this becomes especially complicated because successful tech companies often do become dominant in their specific niches. Google dominates search, Apple dominates premium smartphones, and Nvidia has come to dominate high-end graphics processors for artificial intelligence applications. The question regulators around the world are grappling with this. When does market success cross a line into unfair monopolistic behavior? It's not illegal to be successful or even to be the biggest company in your sector, but it can become illegal if you use that dominant position to unfairly prevent competitors from entering the market or to force customers into unfavorable deals. Nvidia's response to these Chinese laws was pretty much what you'd expect from a major corporation facing regulatory scrutiny. They issued a statement saying they comply with all applicable laws and that they will continue working with regulators to address any concerns. In corporate speak, this translates to, we're not admitting we did anything wrong, but we're not going to pick a public fight with Chinese regulators either. This is actually a pretty smart approach. You want to appear cooperative without admitting guilt. That could be used against you later. But here's what makes this story so much bigger than just one company dealing with one regulatory issue. This is all happening in the context of an ongoing technology trade war between the United States and China. What we're seeing with Nvidia is just one move in a much larger chess game between the world's two biggest economies. The two biggest economies in the world. Let me give you some context on what else has been happening recently in this space. Over the past few months, China has announced investigations into several American semiconductor companies, accusing them of what's called dumping, basically selling products in China at prices that are allegedly below fair market value. Companies like Texas Instruments and ON Semiconductor have been specifically mentioned in these investigations. At the same time, China has launched broader probes into what they characterize as discriminatory practices by the US against Chinese technology companies. Meanwhile, the United States has responded with its own sanctions, targeting Chinese firms that are connected to SMIC, which is China's largest semiconductor manufacturer. All of this is happening while trade officials from both countries are meeting in various international forums, ostensibly trying to work out their differences, but the reality is that both sides are using these regulatory actions as leverage in those negotiations. Nvidia finds itself in a particularly difficult position because they are already dealing with significant restrictions from the US government on what kinds of advanced chips they can sell to China. The US has implemented export controls designed to prevent China from accessing the most advanced semiconductor technology for national security reasons. This has forced Nvidia to create what industry insiders call watered-down version of their flagship products specifically for the Chinese market. For example, they developed something called the H20 chip, which is essentially a less powerful version of their top-tier graphics processors, designed to comply with US export restrictions while still allowing them to serve Chinese customers. So Nvidia is caught in the middle. The US government is limiting what they can sell to China, and how Chinese regulators are questioning whether they've been following Chinese rules properly. It's like trying to thread a needle while wearing boxing gloves. Here's why this story is so significant beyond just the companies directly involved. Nvidia isn't just any technology company. As of right now, they're one of the most valuable companies in the entire world, thanks to the artificial intelligence boom that has created massive demand for their specialized processors. When you're training an AI system like ChatGPT, or creating artificial intelligence applications for self-driving cars, or medical diagnostics, you need incredibly powerful processors that can handle parallel computations at a massive scale. Nvidia has become the dominant supplier of those processors, which has made them absolutely crucial to the global AI revolution. So when Chinese regulators put Nvidia in their crosshairs, this isn't just a small regulatory dispute. This is about which country will control the technologies that are likely to define the next decade of economic growth. Now let's talk about what this actually means for investors and anyone who cares about stock market performance. First and most obviously, this regulatory uncertainty creates questions about Nvidia's business in China, which is a massive market for their products. China isn't just important for Nvidia because of gaming or consumer graphics cards. Chinese companies are building enormous data centers and AI infrastructure that require exactly the kind of high-performance processors that Nvidia makes. If Chinese regulators drag out this investigation, or worse, if they decide to impose penalties or restrictions on Nvidia's business operations, investors are going to start factoring in the possibility of slower revenue growth from one of the company's most important markets. Even if nothing ultimately comes of this investigation, the uncertainty itself can create a volatility in Nvidia's stock price as investors try to figure out what the potential downside might be, right? This isn't just about Nvidia though. When China starts targeting major American technology companies like Nvidia, it often signals a broader shift in policy that can affect multiple companies in the same sector. We've already seen China announce investigations into other US semiconductor companies like Texas Instruments and ON Semiconductor for alleged dumping practices. If this pattern continues, we could see trade restrictions or tariffs that affect the entire American semiconductor industry. For investors like us, this means paying attention not just to individual company stocks, but to sector-wide exchange-traded funds like the ixic ETF, which tracks the performance of the semiconductor companies as a group. So, when geopolitical tensions rise, these sector funds often move together regardless of individual company fundamentals. Interestingly, increased pressure on American technology companies could actually benefit Chinese competitors in the short term. If supply chain gets disputed or if Chinese customers decided to shift toward domestic suppliers for political reasons, companies like SMIC could see increased demand for their products. Of course, this is complicated by the fact that many Chinese technology companies are also dealing with US sanctions and restrictions, so it's not a simple zero-sum game. Here's something that's really important for anyone investing in US stock market indexes. Technology stocks and Nvidia in particular have been major drivers of market performance this year. Nvidia is one of the largest components in major indexes like nasdaq 100 and S&P 500. If Nvidia's stock price experiences significant volatility because of these regulatory issues, that volatility is going to ripple through to affect the performance of those broader market indexes. So even if you don't own Nvidia stock directly, if you invested in index funds or ETFs that track the overall market, you are still indirectly exposed to this story. Now here's an important nuance that I think gets lost in a lot of the short-term news coverage. While these geopolitical headlines can create a significant short-term volatility in stock prices, the long-term fundamentals of the artificial intelligence revolution haven't changed. Nvidia still makes the best processors for AI applications. Companies around the world are still investing billions of dollars in AI infrastructure. The demand for the kind of technology that Nvidia produces isn't going to disappear just because of regulatory investigations. So while traders might see stock price dips, they might see that as opportunities to buy shares at lower prices. The key question is how severe any potential penalties or restrictions might be. If China decides to impose limited penalties or restrictions, that might actually be viewed as a positive outcome because it provides certainty and allows a company to move forward. But if this investigation escalates into broader trade restrictions that could have more serious long-term implications, this situation raises some important strategic questions that I want you to think about. Guys, I want you to think about these questions. So if Nvidia stock price drops significantly because of this regulatory uncertainty, do you see that as a buying opportunity because the long-term AI trends are still intact? Or do you think this represents a fundamental shift in the geopolitical landscape that makes technology stocks riskier investments? Are you more interested in diversifying away from individual technology stocks and toward broader market indexes? Or does this make you want to research Chinese technology companies that might benefit from reduced American competition? And how do you factor geopolitical risk into your investment strategy, especially when it comes to companies that operate in multiple countries with potentially conflicting interests? Drop your thoughts in the comments below. I'm ready to hear that, and I'm really curious to hear how different people are thinking about balancing the growth potential of technology companies against the increasing regulatory and geopolitical risk. And if you're finding this kind of analysis helpful, we will take these big news stories and break down what they actually mean for your investment portfolio. Make sure you hit that subscribe button. Thank you so much, guys. Hit the like button as well. Alright everyone, that brings us to the end of today's deep dive into these three massive market stories. Let's take a moment to recap what we've covered and what it all means for your investment strategy going forward. Let me bring back the pages. So we started by analyzing Tesla's recent SEC filings, and what we discovered was a masterclass in how to read between the lines of corporate documents. Elon Musk's billion-dollar personal stock purchase isn't just a financial transaction, it's a strategic signal that demonstrates confidence in the company's future while potentially setting up important changes in voting control. The key lesson here is that while everyone else is reacting to headlines, smart investors are reading the actual filings to understand what's really happening inside the companies they are investing in. And then we dove deep into Federal Reserve. We talk about the Federal Reserve policy. We talk about the policy and the interest rate cuts. And I hope you now understand why this isn't just about whether rates go up or down. The reason behind the rate changes matters just as much as the changes themselves. And we explored how different sectors respond to rate cuts, why the timing and the context matter so much. and how you can position your portfolio to benefit from these macroeconomic shifts rather than just hoping for the best. Finally, we examined the Nvidia China. We talk about the Nvidia China situation, which perfectly illustrates how geopolitical risk has become one of the most important factors in modern investing. This story shows us that even the most successful companies in the most promising sectors can face significant regulatory changes that create both risk and opportunity for investors who understand how to analyze these situations. Here's what I want you to take away from today's stream. Successful investing isn't about picking the right stock or timing the market perfectly. It's about developing the skills to analyze information that most people ignore. Understanding the broader economic and political context that drives market movements, and building a framework for making decisions based on facts rather than emotions or hype. Every single topic we covered today, from SEC filings to Fed policy to geopolitical risk, these are tools that you can use to evaluate any investment opportunity. Whether you're looking at individual stocks, sector ETFs, or broader market index funds, the analytical approach we've demonstrated today will help you make more informed decisions. Now, I want to hear from you in the comments. Let me hear that. Which of these 3 stories do you think will have the biggest impact on the market over the next few months? Are you more focused on the short-term traditional opportunities these situations create, or are you thinking about how to position yourself for long-term wealth building? If you found today's analysis valuable, here's what I need you to do. First, hit that like button to help this content reach more serious investors who want to learn these skills. Second, subscribe to the channel and ring that notification bell so you don't miss our upcoming streams, where we will continue to break down complex market situations. And third, and this is really important, share this stream with someone you know who's interested in investing but might be getting their information from less reliable sources. One of the best ways to improve your own investment knowledge is to discuss these concepts with other people who are also committed to learning. We are building something special here, a community of investors who care more about understanding markets than following trends. We want to build wealth through intelligent analysis rather than gambling on hot tips, and who understand that the best investment strategy is one based on continuous learning and improvement. Make sure you're subscribed, because next week we're going to dive into earnings season analysis, where I will show you exactly how to read quarterly reports and identify the companies that are setting themselves up for long-term success. And we will also be covering more Federal Reserve developments as they happen, and keeping track of how the US-China trade situation evolves. Please remember the stock market rewards patience, knowledge, and disciplined analysis. The tools we've covered today will serve you well, whether we're in a bull market or a bear market, or the kind of mixed conditions we're seeing right now. Thanks for joining me today. Thanks for being part of this community, and I'll see you in the next stream. Until then, keep learning, keep analyzing, and keep building wealth through intelligent investing. Guys, take care.